Hello, investors and traders. For this week's infographic, we cover how investors lose out to emotion. It's a dangerous thing. Without education and setting parameters and limits, emotions can flood even the wisest investor. As we always said on OII, the key is to remove as much as the emotional component as you can, setting limits, stops, etc. But let's take a look at how investors are losing to emotional investing. Euphoria leads to confidence. A buyer jumps in and feels emotionally confident, and they're going to experience a win. Denial. Denial leads to fear. If a stock price drops, investors lose out to emotion, and when they double down and increase their position at bargain price. Panic leads to capitulation. The investor has already held on too long and agony becomes so great, they may finally jump out of rock bottom. Agony and depression lead to disinterest. The once euphoric investor has now been hurt by the experience badly enough, they may not want to give it another shot. Giving up or giving in is the worst way an investor can lose out of emotion. We've all made investment mistakes. We should be wise and write them down and learn from them. So let's start from the beginning. Let's go over some of the emotions. A lot of videos we all do is going over the stages, the accumulation phase, the growth phase, the distribution phase, and declining phase. All stocks at one point go through these phases of accumulation, of basing, of super growth upwards, and distribution and declining. What we want to do on each of these phases is go over a little bit of your emotions. It's one thing to say the stock is in them, but by understanding your emotions, you'll understand the investment sentiment wheel. Most investors move in direction opposite to the market of the cycle. What we're trying to do always is understand market sentiment of the stock, which phase the company in, how the overall sentiment is going. We use over 100 indicators to give a weight of evidence. But this today is more about the emotions. So let's start with basing. Market trough, lowest price. It's a good time to buy. At this point of time, it's a lot of capitulation. It's a lot of agony. It's a lot of depression. The stocks are just moving in one direction and not moving up. We are waiting for a breakout. This breakout is usually the most violent breakout, and it's usually off to the races, followed by 1 to 2 or 3 straight days of up. So imagine 6 months of agony, capitulation, or depression of being in the stock. And then suddenly, out of nowhere, after the 6 months of up, it jumps into the growth phase. And that's the phase you really want to get to. You can see the accumulation phase a long time, but a true accumulation phase will lead into the growth phase. The herd starts turning bullish. How will you feel? Disinterested, uncertainty, and then finally some optimism. You will see the stock move upwards, day after day with little pullbacks, and everyone will be saying it's overbought. Understanding this move, it's great to understand this move. You'll say it's still too early. I will watch the market. Again, this growth phase is the right time to get in after coming through an accumulation phase, a basing phase, the growth phase. Then you go into distribution phase. This is suddenly where you see enthusiasm. You see euphoria and confidence. You will feel that you are missing out. You'll increase your profit prices there and have super confidence. I missed the consolidation, so I have to get in now. The worst time to get in. And then it goes. I am a long-term investor. I am holding on. You just bought at the distribution phase on the top phase, and you go down to the declining phase. You will have denial in what you believe. You will have fear, what you believe. You will have panic. The herd starts turning bearish. These are the 4 phases. We have done many videos about the 4 phases, but this is really a video that's going in how you would feel in each one of these phases and what you're feeling or what the person is feeling. I try to have no emotion when I'm investing, and this is the cycle of investor sentiment. Let's continue for some other points. Don't fall for these common mistakes. A $25 share is cheaper than one trading at 2,500. It's the same price as if trading at 25 or 2,500. Just because you can afford more shares of something does not mean that it's a better buy. You have to go again back to this. Is it in accumulation phase? Is it in growth phase? If it's at 25 in a distribution phase and it goes at 15, you still lost money. If it's at 5,000 going into accumulation to growth phase and it's at 10,000 over here, you made money. So the price is not so important. PE ratios. PE ratios can be used at a certain period of time, but in a bull market, technology will run and PE ratios will be at all-time highs breaking out. So as a trader, as a technical analysis, you can put the PE ratios somewhere inside of your investment philosophy and your investment system, but it should not just be your only argument. The PE is low, so I must buy. Imagine buying low PE on the accumulation phase to growth phase, or getting out with a high PE distribution phase, declining phase. But for us, PE means very little, much of nothing. What comes down in the market must come up. If a company is performing consistently well, its stock price may rise steadily. However, even a growing company may see its stock price fall, the market turns bearish. On the other hand, a company whose shares have been beaten down and may never rise again, especially if it's poorly managed. What comes down in the market must come up. That's not necessarily true. There are many stocks in the 80s that never have come back. And there are many stocks in the year 2000 that have never come back. And there will be many stocks in the year 2020s that will never come back. Index-based stocks are safe investments. Not necessarily true. Sure, if you hold something on for 10, 20, 30 years, the market, of course, is bullish. But if you are keep riding into a distribution phase, into a declining phase, the profits will not be as much good if you understand the investment sentiment wheel. A stock trading at a 52-week low is cheap. We like to buy on stocks at 52-week highs and sell short at 52-week lows. We feel that gap ups at the highs is the best way. When a stock is breaking the 52-week high, there's more chances that we will keep breaking these 52-week highs. Will we have a pullback? Absolutely, but we will still go up higher. Start with a small amount. Avoid investing large amounts in the beginning. Buy small quantities at regular intervals and try to get a real feel of the market. Have realistic expectations. Stocks create wealth, but don't expect to get rich overnight. You might earn muted returns till you get the hang of the markets. Learn from failures. As a novice, you are bound to make some mistakes. Don't get discouraged. Instead, analyze what went wrong and learn from them. Invest in what you know. Buy stocks and business that you understand. You should be familiar with the company and the sector dynamics. But remember also a top-down philosophy. What is the overall market doing? What is the sector doing? And then break it down into the individual security. Know a little bit about the individual security and the individual sectors. Don't get emotional. Most important. Don't let greed, fear, excitement, and frustration guide your decisions. Maintain a disciplined approach to investing. Remember the investor sentiment wheel. You know the catchphrase. Study it, analyze it, adapt it. Peace.